Your oil bill just dropped, but your mortgage rate might not follow fast enough. Watch this. Wednesday, August 26, 2026. Today's agenda: Iran and Oman sketched a corridor through Hormuz, a third straight green day for the Dow. The whole chip story now runs through margin. One number, one report, one speech. But that oil drop is actually moving something bigger than your gas pump. Brent slid below $87 a barrel in Asian hours, roughly 8% off the price over the past 3 sessions. West Texas had already dropped more than 3% on Tuesday. The reason was signed in Tehran. Iran and Oman set out an interim plan for a temporary joint corridor through the Strait of Hormuz. That waterway normally carries about a fifth of the world's seaborne oil, and it has been largely shut for nearly 6 months. Now, follow the chain, because this stops being an energy story. Expensive crude feeds headline inflation, and headline inflation feeds the long end. 10-year yields fell more than 7 basis points on Tuesday to about 4.6%, a second straight decline. That is the rate your mortgage quote follows, and it moved on a shipping lane rather than a speech. Now, the counterweight in 3 pieces. First, the president said on Tuesday that the Navy had told him every mine was already cleared, which sits badly beside a clearance project. Second, a tanker was disabled by an attack off Oman days before the 2 ministers met. Third, the plan rests on a memorandum signed in June that collapsed within weeks. Nothing is confirmed until loaded tankers move at scale. Watch for weekly transit counts rather than statements. If loadings climb, the drop in yield sticks, and the risk is that one incident puts that 8% back. But even with cheap oil, your biggest worry might be what happens after tonight's earnings. The Dow has now won 3 sessions in a row. It added 160 points on Tuesday to 53,577. The S&P 500 rose 0.3% on Tuesday to 7,677. The Nasdaq climbed 0.7% on Tuesday to 26,151. Chips did the lifting because the sector bought back everything it lost on Monday. Nvidia added 2% on Tuesday and snapped a 7-day losing run. Advanced micro devices gained nearly 5% on Tuesday. Bonds were the reason underneath all of it. 10-year yields fell for a second day, and the dollar eased, which means the reflation trade lost grip. Gold is holding near a 3-month high. Bitcoin sits just under $79,000 after touching $81,023 on Tuesday. Ether is a shade lower at $2,458. Asia was firm overnight. Korea's Kospi jumped 2% on Wednesday, and Japan's Nikkei added 0.6%. American futures are the exception, because Nasdaq 100 contracts slipped 0.5% on Wednesday before tonight's chip report. Read the board as one line, because every asset trades the same falling oil price. Watch for the 2-year yield this morning, because that is where your savings rate gets repriced. And while tech and oil move, inflation data is about to land with a bang. Nvidia reports after the closing bell, and the number that decides the reaction is not revenue. The company guided to $91 billion in May, and the street sits near $92 billion, so that line is already agreed. Growth near 96% over the past year is also agreed. The argument is about margin, and 3 separate pressures run through it. First, memory costs are rising, because the same shortage that lifted Micron raises the bill for every accelerator. Second, reports say some customers face price rises of about 15%, which is a margin transfer rather than new demand. Third, the company already sells roughly 4/5 of the world's artificial intelligence accelerators, so there is nowhere left to gain share. Look at the rest of the complex, because the same theme appears there too. One bank expects adjusted operating margins at a large cloud provider to climb from 1% in the first quarter to double digits by the fourth. Another note valued a coding company bought by SpaceX at about $4 billion of recurring revenue, 3/4 of it from businesses. The story has moved from who can build to who can keep the spread. Watch for the gross margin line and the October quarter outlook, because those two decide whether the fund you own rallies or gaps lower tomorrow. If margin slips while revenue beats, expect the peak argument to get much louder by Friday. The American consumer is losing confidence. The Conference Board Index fell to 89.4 in August from a revised 90.2 in July, the weakest reading since January. Economists had expected no change at all. The expectations component did the damage, dropping nearly 8% on the month. New home sales also fell to their lowest since January, because the cost of living is finally showing up in housing. That matters for your position today, since a softer consumer cuts against the case for a rate rise. The The inflation gauge the Fed watches most closely lands at 8:30 Eastern. Consensus looks for the headline to ease to 3.6% and the core to hold at 3.3%. The second read on second quarter output arrives in the same minute, after a first print of 1.5%. Expect the reaction to come from the core line rather than the growth revision, because that is what the rate market trades. So with oil lower and Nvidia watching, here is your single most important view for today. 3 critical economic markers converge within hours. Core inflation data releases this morning, followed immediately by revised output measures and durable goods orders. Investors must scrutinize the core line specifically, as that single figure dictates the Federal Reserve's September rate decision. Later tonight, Nvidia reports earnings after the bell. Friday morning features Kevin Warsh's inaugural Jackson Hole keynote as Fed chair, where expect a strategic rate shift towards supply-side themes rather than standard policy outlooks. My forecast holds the 10-year yield below 4.5% this week, though an oil premium drains faster than sticky inflation data can offset. However, a core print of 0.3% changes everything. A strong chip company outlook reignites growth expectations, which would push yields above 4.75%. History shows markets overreact to single prints. The long end absorbs headline noise before settling. Your mortgage rates hinge on these 2 days, as do fuel costs and broad index fund price levels. If inflation proves sticky, bond prices fall immediately and borrowing costs spike fast, creating a second-order squeeze on consumer spending that could derail earnings growth despite strong corporate reports. Conversely, soft data forces the Fed's hand toward cuts, potentially triggering a rapid equity rally. Yet, investors must beware of risk asset price bubbles if cash expands too quickly without underlying productivity gains to support such moves. The interplay between sticky inflation data and oil premiums remains pivotal. Strong chip performance may offset broader economic concerns temporarily, but the core inflation print remains the primary driver for bond yields and mortgage rates. A 0.3% reading signals persistent inflationary pressure, while lower readings suggest easing conditions. Markets will digest these nuances before reacting fully to Nvidia's results or Warsh's speech. The Fed's strategy shifts towards supply-side themes, meaning traditional policy expectations may not hold. Investors should monitor how the long end of the yield curve absorbs initial volatility. Borrowing costs remain sensitive to these data points, influencing everything from consumer spending to corporate investment plans. A rapid rally in equities could emerge if the Fed pivots quickly, but sustainability depends on real productivity improvements. Without them, asset bubbles form as liquidity expands unchecked. The coming days will define the trajectory for interest rates and equity valuations alike. Today's market was a study in contrasts. Oil dropped to $80.84 because of the Hormuz deal, but Bitcoin climbed to $79,027 on steady demand. Nvidia earnings tonight will decide if tech keeps rising or if margin fears take over. Inflation data